Hey, hello and welcome everyone. So in this video, I'm going to talk about decisions involving uncertainty. So we want to learn how to make good decisions when you don't know what's going to happen. So this involves risk aversion, reducing risk, and then behavioral economics applications. So firstly, risk aversion, we want to learn how to make good decisions when the outcome is uncertain. For reducing risk, we want to apply 5 strategies for reducing risk in your life. And then for behavioral economics, we want to overcome common pitfalls when faced with uncertainty. All right, so risk is a set of probabilities and payoffs. If your winnings offset your losses on average, it's a fair bet. So this is going to be a gamble that on average leaves you with the same amount of money. So think of like the expected value. It's going to be the same. All right, risk-averse individuals reject fair bets. Individuals who are risk-averse dislike uncertainty. So it's not the fact that they're going to hand between two choices. One's a fair bet and the other one, maybe it's the same amount of money, but with absolute certainty. The risk-averse individual will take the one will accept the one that's just like the constant payoff, and then will reject the one that involves that has the gamble, just by virtue of the fact that there's uncertainty involved, because it could turn out better and it could turn out worse. To evaluate a risky choice, you need to think in terms of marginal benefits. We're thinking about diminishing marginal utility. Marginal utility is the highest when you're poor and declines as your wealth grows. If we're thinking about utility versus wealth is our graph, we'll see that next. Utility is your level of well-being. Marginal utility is the additional utility you get from one additional dollar. Diminishing marginal utility is the idea that each additional dollar yields a smaller boost to your utility, less marginal utility, than the previous dollar. So here would be the graph. Your utility function describes how your well-being varies with your level of wealth. As wealth rises, diminishing marginal utility means that further boosts to your wealth yield smaller boosts in utility, causing the utility function to flatten. So it's going to be flatter as we go out to the right. Notice the vertical axis was utility, horizontal axis was wealth. All right, so we have your initial wealth is like right here, and we're thinking about what's going to happen as you get additional dollars. Here's what's happening to your utility, or if you lose dollars, here's what's happening to your utility. All right, so your utility function is going to relate how our well-being is changing with changes in wealth. Suppose that change in wealth is the utility gain from, or we're interested in the gain of $20,000. We want to know what's going to be the impact on your well-being. Well, okay, so if we're saying the utility gain from winning $20,000, here's your initial wealth, $20,000, utility gain from $20,000. Actually, I want to probably skip ahead. I remember how these slides are, so I'll just go all the way to the end here. So your utility gain from winning $20,000 is smaller than the utility loss from losing $20,000. So think of like moving along the wealth axis by 20,000 or moving down the wealth axis by 20,000. Look what's happening to the vertical height. It's a bigger distance here, meaning we're losing, our utility has fallen more when we're going from here to here than it has risen going from here to here, right? So as I go from the initial starting point to the 20,000 increase in wealth, my utility has risen by less than it falls going this way. That's the idea. So all right, diminishing marginal utility means the size of the utility gain from gaining $1 is less than the size of the utility from losing $1. And that's what we saw illustrated on that graph. Risk-reward trade-off. You don't want to eliminate all risk. If you eliminate all risk, you eliminate opportunities for good outcomes. But there's a trade-off between reward and risk and reward. So here's another looking at the graph. The greater the reward, the more likely you are to take the risk. High risk, low reward. Risk aversion leads you to refuse a fair bet. Right? This fair bet fails the cost-benefit test because the utility gain from winning $20,000 is smaller than the utility loss from losing $20,000. So risk-averse individual rejects this one. Why? Because the utility gain from winning $20,000 is smaller than the utility loss from losing $20,000, assuming those are the two outcomes that could happen. Right, so the left panel was what we were just, I'd make this smaller. The left panel is what we were just looking at, high risk, low reward. What if we have the same risk, but a higher reward? Bigger payoffs make the bet worthwhile. The higher reward bet passes the cost-benefit test because the utility gain from winning $30,000 is larger than the utility loss from losing $10,000, right? So the idea is, well, here we've got same risk, but a higher reward. And that's going to be something that potentially our agent is going to accept. All right, so the risk-reward trade-off for investments. So here's our reward, average annual return. Here's our risk, standard deviation of the annual return, right? Standard deviation is going to tell us something about the spread. So you have like our whatever is the average annual return, and then but sometimes it could be higher, sometimes it could be lower. Standard deviation is going to tell us something about the width of the distribution, centered around the expected value, centered around the average. So higher standard deviation means there's more variability, and smaller standard deviation means it's more concentrated around its average, more predictable. So let's see, treasury bills have really low reward, but also really low risk. Emerging market stocks, small company stocks have quite a bit reward, but also quite a bit more risk. And you can think of all the different kind of investments along this line. People who are more risk averse will accept fewer risks regardless of the reward. Risk aversion motivates many of the choices that you make. So we have our two characters, one that's slightly risk averse, one that's very risk averse. So the one who's slightly risk averse, in this case, the gamble passes the cost benefit test because the gain from winning 30,000, utility gain, bigger move right here between the vertical height at this point and there, is greater than the utility loss from losing 10,000. The drop in utility is smaller than the rise in utility when we go 30,000 this direction versus 10,000 this direction, assuming those are the two things that can happen in this gamble. But for this character, we have the 30,000 gain is going to get us to a lower point relative to, by proportion, right, than this drop of 10,000, right? So the utility gain from winning 30,000, the vertical height, change in vertical height, right, is smaller than the utility loss from losing 10,000, the change in vertical height. So we represent risk aversion or very risk averse by really steep and then really flat, right? Whereas less risk averse would be mostly flat. Okay. All right, so how risk averse are you? Suppose you have a good job guaranteed to give you your current income every year for life. You're given the opportunity to take a new and equally good job with a 50-50 chance it'll double your income forever and a 50-50 chance that it'll cut your income by a third. Would you take the new job? Well, I mean, this depends on what your current income is. So people probably want more than whatever is their current income for every, anyway. So, but hypothetically, I'll stick to the example. So yes, what if it was a 50-50 chance to double your income and a 50-50 chance to cut it in half? Would you take the new job? If so, then you're not very risk averse. If no, then you're moderately risk averse. What if it's a 50-50 chance to double your income and a 50-50 chance to cut it by 20%? Would you take the new job? If you'd say, yes, quite risk averse, and then no, very risk averse. Let's see. Okay, that's interesting. I don't know. So it's Professor Wolfer's table, which is okay. All right. So increasing the reward increases the utility of taking the risk. Increasing the risk aversion decreases the utility of taking the risk. Increasing the reward increases the utility of taking the risk. Increasing risk aversion decreases the utility of taking the risk. Whenever you're deciding whether to take a risk, your decision should depend on three factors: the size of the risk relative to reward, yep, whether the stakes are high or low, yep, and then your degree of risk aversion. And then how do you evaluate risky choices? When choosing between options, you'll choose the option that makes you happiest, the option that yields the most utility. If you're choosing between risky choices, you don't know what the outcome will be, so we care about your expected utility. So this is what your utility will be on average if you make a particular choice. That's expected utility. Expected utility is just like expected value, so it's the probability of outcome 1 times the utility of outcome 1 plus probability of outcome 2 times the utility of outcome 2. And this gives us our expected utility. So suppose we have a business that could succeed or fail. The probability the business succeeds times your utility if the business succeeds, plus the probability the business fails times the utility if the business fails, gives us your expected utility from launching the business. So suppose you have $50,000 and are offered a chance to invest in a risky company. If you invest, there's a 50% chance that you gain $30,000, bringing your wealth to $80,000, and a 50% chance the company fails and you lose $10,000, bringing your wealth down to $40,000. Suppose your utility of $80,000 is 8 So what we're doing is we're saying, okay, here's your 80,000 income. We're entering this into like your utility function, which is returning a value that measures your utility. It's just utility is just going to be ordinal numbers. It's just like the rank order matters. So suppose your utility of 40,000 is 6. So we're taking 40,000 wealth, putting this into utility function, getting 6. What I meant by ordinal numbers, this is important for intermediate micro. If we're really taking seriously that 8 is your utility and 6 is your utility, it doesn't make any sense to say that 8 is 2 more than 6, or that 6, like if we, like 2 is what, 33% of 6, and that gets us up to 8, and going down, 8 is, 2 is a quarter of 8, and like that relevant comparison, if you even follow what I just said, it's not how it works. The only information we take about utility numbers is just, 8 is bigger than 6. Matter of fact, also relevant for like intermediate micro type stuff is, suppose your utility of 80,000 is -1, and suppose your utility of 40,000 is -2. That's the exact same preference ranking. What matters is the order. It's that your utility here, your utility number is larger than your utility number here. And that's all we're able to do is then say that you prefer 80,000 to 40,000. And that's the information we can take from these utility numbers. Okay, so that's a little bit of an aside, but anyway, so suppose your utility of 50,000 is 6.5. Should you invest? Well, yeah, if your expected value is going to be higher than 6.5. So your utility of not investing is the 6.5. Right, that was like your utility of 50,000. You already have 50,000. Your utility from 50,000 was 6.5. You could invest and get 80,000 with probability 1/2, or you could get 80,000, which yields a utility level of 8 with probability 1/2, or you could get 40,000, which yielded a utility level of 6 with probability 1/2. This gives us a 7. The expected utility of 7 is bigger than your utility of not investing. So yeah, you ought to invest. Since your expected utility from investing is greater than your utility from not investing, you should invest. All right, using the same information as in the previous example, suppose this time there's only a 20% chance that the investment will succeed. Should you invest? No, because the expected utility of the investment is lower than the utility of not investing. Right? So you change this calculation, it would be 20% chance of the investment succeeding. So it'd be 1/2 times, no, it'd be 0.8 times 8 plus 0.2 times 6, right? And that would be, no, the expected utility of the investment is lower than the utility of not investing. All right, so why do people gamble? Some people seem to seek out risk rather than avoid it. We call these people risk-loving. We speculate that gamblers are risk-loving. Risk-loving individuals like uncertainty. Reducing risk. Be ready to apply 5 strategies for reducing risk in your life. The 5 strategies are risk spreading, diversification, insurance, hedging, and gathering information. Risk spreading is breaking a big risk into many smaller risks so it can be spread over many people. Make risk-averse choices when the stakes are large. Make risk-neutral choices when the stakes are small. Risk-neutral means being indifferent to uncertainty. Risk spreading explains why big investments require lots of shareholders, because it's spreading out, taking the big risk into many smaller risks. It can be spread over many people. Diversification reduces the risk by combining a large number of small risks whose outcomes are not closely related. So this is like the exam question example. Would you rather have an exam that has 5 questions, 50 questions, or 500 questions? Right? Well, on a 5-question exam, if you end up getting like a bad draw, then before you know it, you're at an 80% if you miss a question. Whereas, if you have more questions, you can kind of spread out, just reducing risk by combining a large number of small risks by more questions. And this ends up being an effective way of reducing risk. Yeah, other things equal, you'd rather have the exam with more subject to like time considerations, I suppose. All right, so investors use diversification to make stock investments less risky. An index fund is an investment that automatically invests predefined portfolio of stocks. Investors ensure the risks are not closely related. So the riskiness of a stock portfolio relative to holding one stock is right here. It's pretty risky. And as you add stocks to your portfolio, your riskiness falls. And then actually, the pretty efficient way to do that is through index funds. not investment advice. All right. So although very, very, very important to start investing and investing for retirement sooner than you think that would be a good idea. I regret having not set aside money from when I was in college. And so I had this pretty good tutor job where I was a tutor in the math lab, and I was able to get paid a couple $100 every month, and I wasted that money. What I should have done is invested at least some of it, or saved it and then invested it, or whatever it was, and that would have been worth a lot more. That would have been worth a lot more today. But anyway, so diversification is not just about investment. It also applies to all risks in your life. Diversification reduces risk, but doesn't eliminate risk. So the idea is like you can diversify away some risk, but not systemic risk. All investments are exposed to systemic risk, risks that are common across the whole economy. So you can diversify your portfolio by investing in a bunch of different stocks. However, if the entire stock market goes down, then that's a systemic risk that you haven't been able to reduce, because diversification is not going to help you there. So this would be like putting all your eggs in one basket and putting all your eggs, now separating out your eggs into several different baskets, but those baskets are still within the stock market. So anyway, all right. Insurance is a problem of compensation. Insurance is a promise of compensation if a bad thing happens. The price of insurance is the premium. Risk-averse people should buy actuarially fair insurance, meaning that this is a policy that, on average, is expected to pay out as much in compensation as it receives in premiums. Insurance prevents a risk-reward trade-off. Insurance reduces your risk, but if it's not actuarially fair, you'll pay more than you'll get back. Insurance is likely to be a good idea if it's closer to being actuarially fair, if you're risk averse, and if the stakes are large. So that's when insurance would be a good way to reduce risk. A hedge is an offsetting risk. Hedging therefore reduces risk by acquiring offsetting risks. So for instance, Southwest can bet hundreds of millions of dollars that fuel prices would rise. When fuel prices did rise, it increased their fuel cost. However, it was offset by the revenue it made from its gamble. Right? So this would be like if you're investing in both umbrella company what happens when there's lots of sun out? I don't know. It's like a summer outdoors. So I not uncreative today. Yeah, the idea is that you invest on two sides of whatever is the equation. Anyway, so gathering information. Information is valuable to risk-averse people because it reduces uncertainty. The less uncertainty there is, the less risk you face. Value of information is greater, the more it reduces uncertainty and the higher stakes involved in the risk. So gathering information is a way to reduce risk. It's valuable to risk-averse people because it reduces uncertainty because you have more information. The less uncertainty, the less risk. And then the information value is bigger, the more it's going to help reduce uncertainty, and then the higher the stakes are involved in the decision. All right, suppose you've studied well enough to earn 92% on an exam on average. You prefer an exam that has more questions because the likelihood of you earning an A is higher. This is an example of diversification. Right? Okay. And then behavioral economics, how people make mistakes around uncertainty. Prepare to overcome the common pitfalls when faced with uncertainty. How do people process information? What does this mean for economic decision making? Well, we have application of behavioral economics. Now, behavioral economics involves a whole variety of different things. One realm focuses a lot on cognitive biases. That's kind of what this is going to do. But there's a lot of behavioral economics is pretty wide, and there's a lot more interesting things besides just this, but this is what we have here. Behavioral economics is an economic analysis that includes psychological factors in assessing how people make economic decisions. Yeah, that's a pretty good definition. You're probably overconfident. This is overconfidence bias. Overconfidence is a tendency to overrate the accuracy of your forecasts. This can lead you to underestimate risks and make bad decisions. Right? So I won't answer all these. This is interesting. So usually we'll do this in lecture, So how many shares are sold each day in the New York Stock Exchange? What's the world's population? How many people live in Idaho? How many Starbucks stores are in the United States? What's the total revenue of Apple? How many Walmart employees does the US have? How many sheep does New Zealand have? How many different books have ever been written? What's the ratio of prices today to prices in 1913? And how many North American mammals have gone extinct since 1500? So you want to give your estimate, and then you want to give a 95% lower bound and upper bound confidence interval. So the way this would work is a confidence interval is saying, all right, I believe the true value lies within this interval with 95% probability, such that if I grab 20 95% confidence intervals constructed in this manner, 18 of them are going to include the true parameter. Now, you could have 100% confidence interval. It's useless. It's just the real number line. And you could have a 0% confidence interval. That's just the point estimate, right? So your estimate alone would be a 0% confidence interval, but it's a degenerate interval because it's just one point. If you made the entire real number lines, you made this like negative infinity and positive infinity, now you've got a 100% confidence interval. So you shrink it down, you put bounds on it, and you have this trade-off between how likely it is it includes the true parameter versus the trade-off of it being useful, because the 100% confidence interval contains a true value, but it's useless. And the 0% confidence interval is useful, but probably wrong. And so that's the idea. So you think about like, what's the world's population? 95% confidence interval. I think it's something like 7.8 billion. And so my confidence interval would be something like 7.5 to 8.5 billion would be my 95% confidence interval. I think it is like 7.8. But anyway, so all these, you just do this and then go look and see what the real value is. And this is just reinforcing the idea that people have overconfidence, like tendency to overrate the accuracy of your forecasts. So probably in a lot of these cases, your 95% confidence interval the true parameter when you actually look these up via Google is further away than what you thought it would be. So anyway, availability bias leads you to overestimate vivid and easily recalled outcomes. Availability bias is the tendency to overestimate the frequency of events that are easily recalled and underestimate the frequency of less memorable events. So this is shark attacks. So like, what's the most dangerous animal? That's not the shark, it's a mosquito. But people think of sharks because they get a lot of publicity. Anchoring bias leads to excessive focus on an initial estimate. So this is a tendency to begin with an anchor or starting point and then insufficiently adjust from there. Like I just told you, I think the world's population is about 7.8 billion. That probably anchors now your estimate. Anchoring leads you to systematically overestimate some probabilities and underestimate others. Representative bias leads you to overemphasize similarity. Representative bias is a tendency to assess the likelihood that something belongs in a category by judging how similar it is to the category. The focusing illusion can help you. Focusing illusion could lead to you mispredicting your happiness. Focusing illusion is the tendency to mispredict your utility by focusing on just a few factors at the expense of others. So the idea is like what you're kind of paying attention to and what you're discounting and disregarding. Loss aversion can make you sensitive to how a situation is framed. Loss aversion is a tendency to be more sensitive to losses than to gains. But just because people sometimes make mistakes doesn't mean they always do. When people fear sharks, it's an example of availability bias because we have constant reminders of sharks. Key takeaways. So every choice involves risk. You face risk whenever the outcome's uncertain. Because of diminishing marginal utility, risks are more likely to be worth taking if the reward is large. If the stakes are low and you're not very risk averse, you can reduce risk by risk spreading, diversification, insurance, hedging, and gathering information. Evaluate payoffs probabilities carefully by avoiding the biases of overconfidence, availability, anchoring, representativeness, focusing, illusion, and loss aversion. Okay, very good. Hope you enjoyed the video, and I'll see you next time.